Hi everyone. Today we'll be discussing Ind-AS 21, the effects of changes in foreign exchange rates. To start with, function currency of the economic environment where it operates. All financial statements prior to Ind-AS were prepared in INR. There is one company which has prepared financial statements in USD, foreign currency, that is ONGC Videsh, which has prepared its financial statements in USD. Foreign currency transaction, foreign operations, presentation of financial statement in foreign currency. Ind-AS 21 does not apply to hedging transactions where Ind-AS 109 should apply on hedging transactions. Presentation of cash flow in foreign currency, the Ind-AS 7 applies to them. Long-term foreign currency items for waiver of rates that adopted exemption under as Ind-AS 7. Foreign currency is the currency other than functional currency. Functional currency is the currency of the primary economic environment in which it operates. Presentation currency is the currency in which the financial statements are presented. Determination of functional currency. Primary indicators. Currency that mainly influences sale price of goods and services. Currency of the country whose competitive prices determine the sales price of goods and services. Currency that influences labor, materials, and other costs of providing goods and services. Secondary indicators: currency in which the funds from financing activities are generated as debt and equity; currency in which the receipts from operating activities are retained. The case there is no response to primary indicators, then check for the secondary indicators for determining the functional currency. Example: Care Limited is in the business of selling energy drinks and sells its products globally. From the total sales of 85% sales comprises of sales from energy drinks. The selling price is determined on the basis of local currency. However, for convenience and consistency in pricing, Care Limited denominates its sales in USD currency, and other costs are mostly incurred in local currency. You are required to determine the functional currency of Care Limited. Answer: in the given scenario, as the selling price is determined, the significant costs of are in local currency. Also, the financing activities are in local currency. Hence, the functional currency of Care Limited is local currency and not USD. Foreign operations. Additional factors. Following additional factors are considered in determining the functional currency of a foreign operations and whether the functional currency is the same as that of the reported entity. Whether the activities of foreign operations are exercised as an extension of reporting entity without a significant degree of autonomy. Whether transactions enter the reporting entity are high or low in proportion to the foreign operations activities. Whether cash flow from foreign operations directly affect the cash flow of the reporting entity and are available for remittance to it. Whether cash flows from the activities of the foreign operations are sufficient to service its expected debt obligations without the fund of the reported entity being utilized. Example: Parent Limited exports from India steel products to major steel members globally. For this reason, it has set up its subsidiary Sun Limited in Australia. Sun Limited undertakes orders from customers in Australia and supplies the goods received from Parent Limited. Sun Limited collects the proceeds from Australian customers in Australian dollars and remits it to the Parent Limited. Parent Limited bears the admin and other expenses of Sun Limited. There is no role by Sun Limited. In this scenario, you are required to determine the functional currency of Parent Limited can be considered for Sun Limited. Answer: Sun Limited does not have a significant degree of autonomy. It is merely an extension of Parent Limited. Hence, the functional currency of Parent Limited will be the functional currency of Sun Limited. Functional currency can be changed in case there is change in underlying transactions. Change in functional currency has to be done prospectively. Transactions of foreign currency in functional currency. Uh, Initial measurement. Foreign currency transactions are converted at the spot rate at the date of transaction. Subsequent measurement. Monetary items, they are measured at the rate at the reporting date. Non-monetary items, revalued items at historical cost or rate at the date of transaction or revaluation. Monetary items are debtors, cash, trade payable, cash and cash equivalents, accounts receivable. Non-monetary items, PP, inventory, prepaid expenses, non-monetary liabilities, government grant, deferred income. Monetary items, any exchange differences in monetary items claims to be recognized in P&L in the period in which they arise. Non-monetary items where the gain or loss of a non-monetary item is recognized in the other comprehensive income. Any exchange component in that gain or loss shall be recognized in OCI. Conversely, if any gain or loss of non-monetary items is recognized in the P&L, then any exchange gain or loss on the non-monetary items will be recognized in P&L. Example: during January 2018, Goodluck GmbH in the German-based company purchases on credit a machinery from Canadian vendor for Canadian dollar 7 lakh. Then the exchange rate of is dollar one is equal to Canadian dollar 1.75. The company records the asset at Canadian dollar 4 lakh. Good luck values at the year end 31/3/2018 and the amount has not been settled yet. The closing date the $1 is equal to Canadian dollar 1.71. You are required to explain the treatment to the company. Answer: items are measured at the closing rate. So amount payable should be 7 lakhs divided by 1.71, that is 409357, and exchange loss of 9357 in P&L account as it is a monetary item. Machinery will be recorded at historical cost Canadian dollar 4 lakh less depreciation. Translation approach. Functional currency. Determine the functional currency. Presentation currency: the standard permits presentation of accounts in any currency. In a group with subsidiaries, associate and JV, reporting units, parents to present the accounts in any currency. Translate foreign currency items in functional currency. Translation as per below. Translate individual accounts in presentation currency of the parent. Report the difference. P&L average rate, balance sheet closing rate, monetary items at closing rate, non-monetary items at historical rate. Transactions of results in presentation currency. Assets and liabilities at closing rate at the date of balance sheet. Equity at the date of transactions. Income expenses at average rate. Exchange differences separately component of at equity. Transactions of foreign operations. Asset liabilities at closing rate. P&L at average rate. Example: Capital Limited parent functions currency in GBP and its subsidiary functional currency is Euro. Capital Limited as a part of its business sells inventory to subsidiary GBP for 1000. After reporting date, the subsidiary is yet to make the payment and is expecting to make the payment in foreseeable future. Capital Limited had transactions of GBP 4000 to subsidiary and is not expected to be repaid. You are required to determine should the charge be recognized in P&L. The repayment is planned. The gain or loss should be recognized in P&L. Therefore, Capital Limited should recognize the gain or loss in P&L. If repayment is not planned, it is as a capital contribution to the subsidiary and is recognized in OCI in the equity. Disposal of foreign operations. 100% shares in subsidiary are sold off. 100% FCTR balance is transferred to P&L. 85% shares in subsidiary are retained and 15% are sold off. Then gains and losses in NCI. 15% of FCTR balance transferred to NCI. 85% is retained. Loss of control. Point number one to be followed. Example: Sun Limited owns 100% in Earth Limited. During the year, Sun Limited sells 65% at investment in Earth Limited and loses control of Earth Limited. On the date of disposal, the entire balance in the foreign currency transactions of Sun Limited is reclassified to P&L of Sun Limited. Answer: The accounting is correct, full FCTR balance is to be transferred to the P&L account. Example, Sun Limited 100% in Earth Limited during the year. Sun Limited sell 15% in Earth Limited. However, control is retained. In this case, 15% of FCTR balance transferred to NCI. Alpha Limited owns 45% of Beta Limited associate. During the year, Alpha Limited sells 15% share in Beta Limited. However, it still retains significant influence in Beta Limited. In this scenario, 15 by divided by 45, one third of FCTR balance transferred to P&L account. Difference in subsidiary balance transferred to NCI. Associate and JV balance transferred to P&L if there is no loss of control. This brings us to the end of the session. Please do like, subscribe the channel. Thank you so much.